the Bermuda reinsurance loop. While the asset mix was shifting, the real accelerant lived in a legal document, a reinsurance treaty that moved liabilities offshore. Here's how the loop works in practice. A U.S. life insurer cedes a big block of fixed annuities to a Bermuda affiliate under common control. On day one, reserves and future promises slide to the Bermuda balance sheet. Back in the U.S., the ceding company books reserve credit, which instantly frees capital. Capital freed at home means room to invest more, report stronger ratios, and grow faster. Factual clarity: Bermuda's regime is internationally recognized. The arbitrage critics cite is lower capital intensity for certain risks and model-based recognition of diversification and hedging. Why Bermuda? Its prudential regime is recognized internationally and isn't a free-for-all. But its solvency framework, which incorporates internal models and recognizes diversification and hedging differently than US RBC, can treat certain assets and risks more favorably. That's the regulatory arbitrage critics' point too. Not law-breaking, but a choice of venue where the same risks cost less capital. When your spread depends on how much capital you tie up, moving liabilities to a place that prices capital lower is powerful. On paper, everyone wins. The U.S. insurer improves its risk-based capital and looks safer to policyholders and regulators. The Bermuda reinsurer, sharing the same corporate umbrella, applies models tailored to the portfolio it holds, often heavy in private credit, structured assets, and affiliated deals. The group's consolidated economics look great, but something subtle changes. The risk that backs your promise now lives under a different rulebook, with disclosures that don't land neatly in your state's public filings. Meanwhile, something else is happening in the assets. Once liabilities are in Bermuda, the reinsurer can buy the kinds of loans and tranches the sponsor originates. Because the reinsurer is part of the same corporate family as the asset manager, affiliated transactions crop up. Best execution policies are supposed to police pricing and terms, but in private markets the guardrails are mostly internal. Bermuda's supervisors do examine these structures, yet the look-through a retail policyholder can access is thin. This was the moment everything changed for capital efficiency. The loop created leverage without calling it leverage. Reserve credit booked in the U.S. reduces statutory capital strain. The Bermuda entity holds the risk on a model that often assigns lower charges to a liquid but investment-grade private credit. The group can then scale origination and asset purchases faster than if every dollar of liability stayed onshore under US RBC. When multiplied across multiple blocks and affiliates, it's a quiet flywheel. Regulators noticed. State insurance commissioners convened hearings and work streams to examine captives, affiliated reinsurance, and cross-border capital treatment. The NAIC reworked factors on CLOs and started tightening scrutiny of structured and private assets. The Federal Insurance Office flagged concentration in Bermuda cessions and the opacity that follows. The Bermuda Monetary Authority, for its part, proposed enhancements to its regime and published guidance to bolster comfort. Each step improved pieces of the puzzle. None delivered a simple, public map from your policy to its ultimate assets. Ratings agencies adapted their playbooks. Reports began leaning on three pillars: asset liability matching, liquidity under surrender stress, and the likelihood, never a certainty, of parental support for offshore affiliates. Analysts asked whether funding lines and Federal Home Loan Bank advances could cover spikes in policy loans or surrenders without forcing sales of illiquid positions. They asked how basis risk shows up when bespoke private loans don't hedge cleanly against interest rate swings. They asked about affiliated exposures that tie the insurer's fate to its manager's pipeline. Urgency. The answers here determine whether a transfer delay is a hiccup or a headline. What nobody saw clearly at first was concentration risk building across the ecosystem. Different insurers ceded to different Bermuda entities, but many of those entities bought from the same origination shops, financed warehouses with the same banks, and tapped similar securitization channels. If refinancing walls rose in private credit, or if commercial real estate needed widespread workouts, the marks and liquidity needs could rhyme across multiple balance sheets at once. That's not a single counterparty problem, it's a network problem. Defenders of the loop make a fair point. Reinsurance has always moved risk to where it can be best managed, and Bermuda is a serious jurisdiction with real oversight. They add that long-dated liabilities align naturally with private assets that throw off stable cash flows, and that sophisticated hedging can tame interest rate exposure. They note that policyholders are still protected by state guarantee associations if a U.S. entity fails, regardless of offshore treaties. All true within limits. Here's the catch. Guarantee coverage has caps and delays. Resolution mechanics assess surviving carriers, which can spread stress. And if the bulk of an insurer's earning power depends on assets sitting in an offshore affiliate with limited public look-through, your confidence rides on boards, models, and management culture you can't audit. When checks are late during a transfer window and call centers cite temporary adjustments, it's the surface ripple of a deep, complex loop. For families, the practical telltales are small but traceable. Rapid annuity growth paired with notes about reinsurance to unauthorized affiliates in statutory filings. Rising percentages of affiliated investments in the investment schedule. Increased reliance on FHLB advances. Ratings commentary that emphasizes liquidity and ALM over plain surplus. None of those are smoking guns. Together, they sketch the Bermuda reinsurance loop at work. The loop isn't a scandal. It's a design choice that maximizes spread by minimizing capital friction. In calm seas, it sails fast. In rough water, it demands trust, in the models, in the managers, and in regulators stitching two regimes together. And trust is hardest to price the moment the rate shock needs liquidity most. Then rates jumped. Not gradually, fast. In 2022 and 2023, the cheapest money in history vanished, and every balance sheet built for low rates had to show its work. For PE-linked insurers, this wasn't an abstract chart. It was a live-fire drill on three fronts: market value, liquidity, and behavior. Promise. If the model truly matches long assets to long promises with conservative liquidity, it should bend, not break. This was the first real test. First, the marks. As yields spiked, the value of existing fixed-income assets fell. Public bonds showed it instantly. Private loans didn't move on a screen, but the math still bit. Models had to update discount rates. Some assets hedged rate exposure, but bespoke credit doesn't hedge like a treasury future. Basis risk showed up in small mismatches that turned into real dollars. On paper, these were unrealized losses. In practice, they narrowed room for error. Meanwhile, policyholders changed their behavior. Surrender requests and policy loans ticked up as CDs and money markets suddenly offered attractive yields with no strings. Annuities sold in a low-rate world looked less special next to 5% cash. In normal times, surrender penalties and market value adjustments slow the exit. But when a family needs funds or sees a better headline rate, calls still come in. Insurers had to either sell assets or find cash somewhere else. Here's where funding lines took the stage. Federal Home Loan Bank advances became a pressure valve. Pledge eligible collateral, get liquidity, avoid dumping illiquid assets at bad prices. Repo markets helped too, but capacity isn't infinite. If multiple carriers leaned on the same backstops at once, costs rose. Ratings analysts started asking pointed questions. How much FHLB capacity is left? What collateral qualifies? What happens if those lines tighten on a busy week? At the same time, parts of the private credit book hit their own weather. Refinancing walls loomed for loans underwritten in the low-rate era. Payment in-kind features, meant as a bridge, got used more. The lever didn't break the system, but it signaled pressure. In commercial real estate, office values sagged, and borrowers needed time, equity, or both. Consumer ABS tied to autos and weaker credit cohorts saw delinquencies rise from historically low levels. Each issue was manageable alone. Correlated across similar mandates, they added friction. Inside the liability stack, hedges faced their own test. Insurers do hedge interest rate exposure, but hedging a book of idiosyncratic, privately negotiated loans isn't the same as hedging a treasury ladder. Prepayment speeds changed. Optionality in ABS and callable loans behaved differently than modeled. Duration extension in some pools clashed with contraction elsewhere. The result was basis risk. The hedge protected one thing while the asset shifted in another way. For a spread business, those basis points matter. The pricing lens shifted too. New annuity buyers suddenly demanded more. To stay competitive, insurers had to offer higher crediting rates on fresh premiums. That helped bring in cash, but it also raised the cost of liabilities for years ahead. Spreads could be protected if asset yields kept up. That nudged portfolios further toward higher-octane private credit and structured tranches that promised extra pickup. exactly when the cycle was the least forgiving. Distributions slowed in pockets. Banks, busy selling their own juicy CDs, pushed fewer annuities. Independent agents adapted, but the story had to change. Today's higher annuity rates looked better, yet surrender terms often stayed tight to avoid a rush out of legacy blocks. Some carriers lifted surrender charges or kept market value adjustments firm. It wasn't punitive, it was survival math. The family on hold with the call center heard about temporary adjustments, while Treasury teams watched collateral ladders by the hour. Service strains followed the money. Reinsurance transfers scheduled months earlier landed in a whipsaw market. Moving assets, novating hedges, coordinating Bermuda and U.S. books. Each step got harder when prices gapped and liquidity thinned. Back office timelines stretched. A check that once arrived on the 1st showed up on the 7th. The promise hadn't failed. The plumbing was groaning. Ratings agencies recalibrated their narratives. Reports leaned hard into asset liability management discipline, liquidity buffers under stress, and the role of FHLB and committed facilities. Analysts wanted to see stress testing that assumed elevated surrenders, clogged securitization exits, and partial hedge shortfalls. They asked about governance around affiliated deals when origination needed takeouts to keep warehouses moving. They reminded readers that sponsor support is helpful, but isn't a binding guarantee. Regulators used the moment. State commissioners intensified data calls on offshore cessions and affiliated investments. The NAIC advanced revisions to capital factors for structured assets and looked harder at how private credit was being risk-weighted. The Federal Insurance Office reiterated concerns about concentration in Bermuda and the broader tie between insurance promises and shadow banking pipes. Bermuda's supervisor proposed tweaks of its own. The perimeter tightened a notch. Inside firms, the talking points met reality. Executives emphasized that most holdings were senior, asset-backed, and matched to liabilities. They noted that private assets, held to maturity, would throw off cash just fine. They highlighted new origination at higher yields that would lift future spreads. Much of that was true, but the rate shock forced choices. Protect liquidity and accept lower near-term returns, or chase yield to backfill spreads and lean on models. Each choice left a fingerprint in disclosures. Higher FHLB usage, slower surrender credits, tweaking of crediting rates, more granular risk language. For policyholders, the signal was simple. Contract terms mattered more than slogans. Surrender windows, market value adjustments, and crediting rate resets carried real dollars. Service delays, even short ones, were tells that the balance sheet was busy. The stress test didn't collapse the model. It exposed how much of the promise depends on time, funding, and confidence when markets move fast. The check eventually arrived for the family we've been following. It cleared a few days late. No headlines, no crisis, just a small delay that pointed to a bigger truth. When rates jump, the new engine has to downshift on a steep hill. Whether it holds the road depends on how honestly the risks are marked, how conservatively the cash is managed, and how quickly the people in charge choose resilience over speed. Regulators, ratings, and red flags. Amid the rate shock, the people paid to worry finally did. State insurance commissioners called data drills on captives and cross-border treaties. They wanted names of affiliates, sizes of sessions, asset look-throughs that didn't stop at private placement. In hearing rooms, staff asked simple questions that had complicated answers. Where exactly are these liabilities? What collateral backs them? Who sets the marks when the buyer and seller share a parent? Solution preview. Regulators pushed for tighter capital on structured assets and better look-through. You can borrow their checklist to protect yourself. While that was happening in New York and Des Moines, the NAIC moved its levers. Capital factors on structured credit, especially CLOs and bespoke ABS, went under the microscope. Drafts circulated that would raise required capital for tranches whose risk had been underweight. Affiliated investments got more scrutiny too. The message was steady, not loud. If you want higher spread with private complexity, you'll carry more capital against it. Over in Washington, the Federal Insurance Office sharpened its tone about offshore reinsurance. The concern wasn't Bermuda's seriousness, it was concentration and opacity. Too many liabilities migrating to the same jurisdiction, too much reliance on internal models tied to affiliated asset managers, and too little public look-through for consumers deciding where to place lifetime savings. The phrase shadow banking slipped into official language. Insurance promises increasingly funded by private credit pipes that sit outside bank regulation. Bermuda's supervisors didn't sit still. The Bermuda Monetary Authority proposed enhancements, from model governance to liquidity stress testing, aiming to reassure counterparts that the island's prudential net was tight. Industry applauded the pragmatism. Keep the capital flexibility that makes reinsurance work, bolster the guardrails that comfort skeptics. It was a diplomatic dance across an ocean of statutes. Meanwhile, rating agencies AM Best, S&P, Moody's, Fitch updated their scorecards. Reports leaned on three pillars. First, asset liability management, duration matching, optionality, and how basis risk in private assets is really hedged. Second, liquidity, playbooks for surrender spikes, collateral ladders for FHLB and repo, and contingency plans if securitization exit doors narrow. Third, governance around affiliates, best execution policies, independent valuation, and the willingness to say no when the pipeline wants to take out the balance sheet shouldn't buy. They also added a quiet fourth pillar, the expectation of sponsor support. In stress, would the asset manager inject capital, backstop a warehouse, or buy paper from the insurer to ease pressure? Sometimes yes, but agencies reminded readers that strategic importance isn't a binding guarantee. It's a judgment call made in the thick of a storm. On the ground, consumer protection looked less like a blockbuster case and more like a string of memos. State departments issued bulletins reminding carriers to communicate clearly during reinsurance transfers, credit interest accurately, and honor processing timelines. They asked distributors to present annuities fairly, headline rates, surrender terms, riders, and risks, without burying affiliated relationships. They fielded complaints about delayed checks and opaque disclosures, then nudged, fined, or required remedial plans. Political pressure simmered. Senators and advocacy groups framed the issue as simple. Private equity controls insurers, shifts assets to opaque loans, and extracts fees while policyholders shoulder tail risk. Industry countered with its own simple line. Insurers fund the real economy with long-term capital, match liabilities with cash-yielding assets, and diversify beyond volatile public markets. Both stories contain truth. The tension lived in the plumbing, not the slogans. Here's where the red flags matter for regular people. You won't read an internal model, but you can spot signals. Rapid annuity growth outpacing peers, especially if paired with notes about reinsurance to unauthorized affiliates or Bermuda captives in statutory filings. Rising percentages of affiliated investments, assets managed by or bought from related parties, without much detail on pricing or oversight. Heavy reliance on Federal Home Loan Bank advances or other short-term facilities in the liquidity footnotes, especially if usage trends higher across quarters. Ratings commentary that shifts from simple surplus strength to repeated focus on ALM, funding profiles, and the role of sponsor support. Product terms that quietly lengthen surrender periods, keep market value adjustments tight, or offer teaser crediting rates that drift lower after the first year. Advisors face their own mirror check. Commissions on fixed annuities are real. So is fiduciary duty. Good advisors began asking for asset look-through. What share is private credit? What slices of CLOs or ABS? What's the affiliated exposure? And where are the liabilities reinsured? They pushed carriers for plain English answers on liquidity plans during stress. When answers came thin, they steered clients toward simpler products or mutual insurers with conservative ALM and fewer affiliated ties. One more flag sat in plain sight: disclosures that arrive late and read dense. Complexity thrives in lag and jargon. If it takes a financial analyst to tell you what backs your benefit, you're not the customer, you're the funding source. Back at our family's kitchen table, the lesson was practical. The call center can't explain RBC ratios or Bermuda's internal models, but the red flags show up in the policy packet and the insurer's public filings. If the carrier grew fast, seeded big blocks offshore, leans hard on private assets managed by its parent, and finances liquidity with FHLB lines, you're buying a promise that depends on a complex web holding together. That may be fine. It may even pay a bit more today. It also asks you to trust people and processes you'll never meet. Regulators can close gaps. Ratings can warn. But the cleanest protection, for now, is choosing where you place your promise with open eyes, and knowing which yellow lights means slow down, not speed up. Who profits, who pays?